First rates this Friday morning on your screens, holding up 0.5% higher almost, just 10 points away from that 19,500 mark. This market does not want to rest at all. It just wants to charge up ahead. But having said that, these are just early days yet. Let's see what happens yesterday. Today, towards close, much like yesterday, we could give up these morning gains as well. And remember, yesterday was a bigger crack when it came to the broader end of the market. Both the Nifty small cap as well as the mid cap index, they fell harder, were down about almost 1.6% from the intraday highs. On your screens then, Hindalco, Infosys, Tech Mahindra, Tata Steel, Ultratech Cement, LTI Mindtree, they're all holding up in the green. Wipro has actually had a smart start. That stock is holding up by about almost 1% there. 397 is where Wipro is currently in trade. Just want to check in on all the other movers as well. And let's start off with not just Wipro, but ONGC as well. Given that oil prices now are at 81, that stock should be holding up in the green. Yes, it surely is. Some of the other earnings reactions and some smaller ones at that. Angel One, the gross client addition is higher sequentially by about 2.5%, so look out for that. JBM Auto was already sitting on a gap up in the pre-open rates itself, but after that order of approximately about 5,000 electric buses, JBM is gap up 13.5% as we speak right now. Tata Metaliks, though, a bit of an earnings disappointment there. The EBITDA has seen a decline of about 62.5% on a sequential basis. The revenues as well lower by about 30%. So then, of course, there's RVNL after that letter of award that they got for the NHI project worth about over 800 crore rupees. There's GMR Power, Ahluwalia Constructions, which has also bagged a 200 odd crore rupee order in the state of Odisha. And then Patanjali Foods, let's see what that stock is up to and whether or not, it's seeing any recovery post the move that it had on the stock yesterday after them announcing that they're not looking to exercise the green shoe option of the OFS issue. Naukri, Birlasoft, TCS, Coforge, Infosys, these were your big winners from yesterday. That's where the strength still continues, Anisha.
Well, yes, absolutely. So IT remains a pillar of strength and we're watching out for that as well. But what else is happening in the broader markets? I think we flagged out JBM Auto, which was high by 15%, GMR Power doing quite well. Sunteck Realty, that one is perking up 5%. Realty actually has been in a good space of late. So today is the day of Sunteck Realty. You also have names like Patel Engineering, high-tech, etc. from the broader markets which are doing well. Data Patterns continues the up move as well. So overall, looks like the market has started off well. Of course, Wipro is holding up with a gain of 1.5%. This is despite the kind of weak numbers, weak guidance that the company reported. So for now, the market is completely ignoring what's happening with respect to the fundamentals of what the companies have reported in Q1. They're talking about Q2 and the way forward and the recovery. The Nifty is back above the mark of 19,500 and the advanced decline ratio very, very solid. So overall, a good trading session, at least at the start, is what we have for us. Let's go across to our charters to get the first trades going. Kunal?
Well, that would be ICICI Bank. So again, good start for the bank Nifty. We've bounced off, I think, 200 odd points on the banking index. ICICI Bank is holding steady about the 960 mark. So that's the first trade which I would look out for in the banking sector specifically.
Right. Vaishali, what are the first trades that you're punching?
So InfoEdge, yes, it has given a good start. So I would continue to stay bullish for 4,800 levels.
Okay, time now to welcome on board Ashish Gupta, the Chief Investment Officer at Axis Mutual Fund, joining us. Ashish, hi, thank you so much for making time and speaking with us. What's your own call on the market right now? Do you see that there are more legs to the rally or a bit of a consolidation, a bit of a pause, and then we'll head to perhaps 20,000?
Sure. No, I think we have seen a very strong rally over the last 3 months. I think we have got support both from the rate side as well as the fact that the initial fears of a US recession have receded. Having said that, I think the global macro is still trending weaker. And there is a need for caution, particularly going into the second half of the year. So I think one has to be very selective in this market. I think valuations have gone up as well. The market is now trading over 20 times earnings. It's a level about one standard deviation higher than the average. So we need to be selective in these markets.
Right. Okay. Ashish, what are you making of the strength in IT? Surprised by that? Or do you think it's a typical bull market phenomena where the street is like, you know what, let's give them time. Maybe a quarter or two down the line, they will improve and maybe the worst is behind us.
Sure. So I think a couple of factors really helping IT. Right? One is the positioning. I think compared to the rest of the market, over the past 2 months, IT was a sector that had been sold down and the valuation gap with the rest of the market had opened up. Secondly, we had seen a sustained rally in the global tech companies. The third, as I mentioned earlier, you have had the fears of US recession receding. I think one other important fundamental change that has happened in the IT sector over the past 4 years has been the cash payout that these companies have started, both in form of dividend and buybacks. And if we see the ROEs the IT companies are delivering today, they are in the range of 25 to 30%, which compared to the rest of the market is attractive. I think this is what is really supporting the fact that despite the relatively muted demand outlook for the current year, there has been a rally in the stock from the oversold levels.
So Ashish, is IT the undervalued sector to bet on from here?
We are actually not really overweight the sector. We believe that we have to be focused on pockets that will deliver growth. For us, sectors like financials, autos, consumer, these are sectors where we are much more positive on the growth outlook. In sectors like autos and consumer, we are actually also expecting a dose of margin expansion to support earnings because these two sectors had challenges in terms of input price pressures, and those are receding now.
Okay, hi there, Ashish. Good morning. Wanted to also understand what the outlook is when it comes to banks. Is that going to continue to remain a compounding story, especially when it comes to some of the frontline large caps?
Yes, and I think we continue to see really cyclically the sector has come out of a major credit cycle of the past decade in a very strong shape. We have seen both private and public sector banks really recovering, and now loan growth there has picked up as well. In fact, lately, even the NBFC loan growth trends have picked up. So if you compare 12 months ago, NBFCs were lagging in terms of growth vis-a-vis banks, but that is no longer the case. And NBFCs have really consolidated their balance sheet, both in terms of liquidity, funding, as well as asset quality. So there were a couple of segments for NBFCs like real estate loans and microfinance that were challenging, and they have cleaned that up as well. So financials is a big overweight sector and a preferred sector for us across both banks and NBFCs.
Overweight on financials, both the banking names as well as the NBFCs. But Ashish, you briefly mentioned that you're quite positive about the Indian consumption story and autos, etc. Specifically within autos itself, what are the areas or themes that you're watching out for? Is it the entire EV play? Is it the two-wheeler bouncing back?
So, in fact, I'll actually add a third dimension is also the auto component space. We are seeing increasingly many Indian companies do well on the export front as well. So one trend we are seeing is, or we are looking to see is pick up in the sector growth rates on back of some demand recovery, given that demand has been under pressure for the past couple of years, and we believe lower income and rural consumption should be bottoming out. But additionally, I think there are several component companies where exports are another meaningful driver. So those are the kind of two parameters that we believe is going to really drive the sector.
Ashish, what's the view on pharma? Are you part of the group which is saying that it's oversold and the opportunities are emerging, or would you wait for that confirmation to happen and only then dabble?
So in pharma, our focus really is more on companies that have a larger domestic footprint. We believe the challenges in the international generic market are here to stay. It's very difficult to, with confidence, predict multi-year consistent growth rates for companies. And we find that people exposed to the domestic market have more consistent growth rates, and we feel more comfortable there.
Okay, fair enough. Just wanted to get in your perspective as well as to where you believe, as a sector is the most overrated space as of now, Ashish.
So I think rather than sector, I think we have to look at specific stocks. We were doing one analysis in our team that really, while the market average PE is 20, but if you look now, nearly a third of the market is trading at a PE of almost 50 times. So I'm talking about companies over $1 billion market cap. So about a third of companies over $1 billion market cap are now trading at a PE of over 50 times. So there are really in terms of valuations, pockets which are stretched. So it's very important that people select stocks where growth certainty is high.
Watching for that growth certainty is certainly important, but Ashish, you're quite, you're getting a bit selective into the market, but what are the key monitorables or risks that you see for the Indian markets? Because of late, the flows are back, there is a lot of, positive momentum around domestic manufacturing, etc. as well. But what are those risk areas? Because monsoon now too has panned out. It's been very, very sporadic and erratic, but nonetheless.
Yes. I think this is what is clearly reflecting in the market multiples, that there are no evident risk. The Indian macro is very, very stable. I think as has now been called that twin balance sheet advantage, that corporate balance sheets are unlevered, bank balance sheets are very clean. Even on the fiscal side, we are seeing fair bit of consolidation. Government capex has already started, and private capex is looking like it will follow. So on that count, everything looks good. I think we still need to actually watch the external front, both from a geopolitical situation. What's happening in Russia and Ukraine is still not over, and also in terms of what's going to happen to global demand, because India, both on the goods and services side, is now fairly exposed to global demand, and that's contributing to a large part of GDP. So services exports, as you know, is about 10% of GDP. And while fears of US recession have receded, I don't believe that it's still entirely ruled out. Europe and China continue to show weaker and weaker data. So I think that is something that will be really the big drag on India's growth is the global outlook.
Appreciate your time. Thank you so much for joining in and sharing with us your outlook on the markets as well as your view on individual sectors. Let's just check in on the overall broader market momentum, because that seems to be intact after yesterday's lackluster move. Just look at some of the winners. You've got a Suntech, HEG at the top of the charts, Karur Vysya Bank, Emphasis, Lemon Tree Hotels. I just want to check in on Delta Corp after the complete hammering that the stock has seen for 2 straight days, relentless selling pressure. Now at 180, the stock is looking a bit stable, 0.6% higher as we speak. In terms of individual sectors, then the support is clearly coming in from the high beta pockets, so real estate, metals, PSU banks, and then you've got the Nifty bank as well as IT index as well that's supportive, while energy, PSC, and even media to a certain extent is in the red. All right, let's move on then to another special voice on the show. It's BSE MD and CEO Sundaraman Ramamurthy's first ever interview. He believes that India has a long runway for growth and that BSE will continue to ride on that. He says that MSMEs will thrive amid rising opportunities.
Take the case of Rajasthan. What all types of SMEs they have? Marble, artificial jewelry, gemstones. How many SMEs operate there? Do we have even 1% of them with us? No. Take the case of Tamil Nadu. We all only think immediately about Tirupur. Yeah. Is it all about Tamil Nadu? What about the Karur belt? What about the Trichy belt? Where you find so many OEMs, so many people who are giving automobile parts, spare parts. Have we touched any of them? Nothing. So in my opinion, if you are talking about SME as providing very huge share of employment, GDP growth, exports, 500 is not even a number to talk about.
How large can it become in the next 5 years in your view?
Sky is the limit.
5,000, 10,000 companies?
Sky is the limit. Sky is the limit. What we need to do is, we need to go, many of them only know their mother tongue.
Sure.
India is a very big country in terms of number of languages. We have restricted capability. The day we realize that we have these type of restrictions and capability limitations, we will outgrow it. We will go to the local, we will talk their language, we will explain them in their understandable language, how it is going to be useful for them to be visible. I will talk to you about a place near Salem. Wonderful wood carvings are made there and they are exported. We don't have any one of them in our SME segment. I can give you hundreds of names, hundreds of examples.
I can see how passionate you are about that subject. This particular question, you're kind of bubbling with energy. I can see that.
Yeah, so it is very close to my heart because it is contributing in a very significant way to Indian economy. I think we have to do a lot more there.
All right. Okay, so I was just looking at your profile before coming and reading about you. I mean, you have a very unique profile. Essentially, you understand risk very well. But what a brilliant time you spent at the other exchange, and of course a foreign bank, and you in a banker. So full circle of financial services is what you understand very well. How are you looking at the prospects of our country right now? And being an exchange, of course, and a veteran in financial services, the prospect and of course the market prospect then, because that will eventually mirror the economy over the long term.
Let me share with you this. We all have seen such times in India where there used to be huge scarcity.
Yeah.
Scarcity for food, kerosene, palm oil, sugar, everything.
Such basic stuff.
Yeah. Today, we don't talk of any of them. India has grown a lot. And in my opinion, India is going to grow even more. This is another pet topics for me. If you look at it, a growth of a country depends mainly on three factors, I must say. Consumption-led growth, export-led growth, and investments-led growth. There is no need for me to further tell anything. In all these three areas, we are excelling.
Yes,
India's own population with 65% plus in the age of 15 to 65, which we call as income earning age or employable age, and which will continue to be in that sweet spot for quite some time to come in the near future. And with a growing middle class, which is known for its consumption capability, and the doubling of the middle class consumption in very regular periodicity, and globally contributing for middle class consumption. The English speaking capability, which is a global language today, of this growing the income earning population, the time zone where we are kept, the legal and regulatory system that we have, which is one of the very good systems in the world, the democracy that we are able to provide, the cultural diversity which we are able to show. I think we are in a great sweet spot for further growth. It's
decades.
going to be a golden era for Indians in the near future to come. Already it is, and it is going to
It will
go
only
further
get
up.
better in the
Yeah,
coming
that's what
decades.
I feel.
So, the street believes that all these efforts put together, the future, the next 3 to 6 years for even BSE is very bright. And they are putting, say, somewhere around 25% kind of earnings CAGR possibility next 2 to 3 years. Do you think that's a fair estimate? Or do you think it can be improved upon?
I am a listed company. I am representing that company. I have very least capabilities to make any forward-looking statements. So I would like to say I cannot add any reply to this question.
At least you can say that the strategic focus, you just come a few months, the strategic focus of your team, you and your team, over the next 2 to 3 years, if you could share visibility on that. Market will of course do their own math and talk about earnings. I don't want an earning reply from you, but the areas of strategic focus from you.
That's a very good question that you have asked. Basically, when in a single sentence, if I have to say, it is we want to unleash the power of vibrance. That is the single sentence which I repeat every time to my team, and my team believes it. I have a wonderful team with me, fully supporting me, which is very evident. Otherwise, I could not have done whatever I have done in the last 6 months. 6 months is too small a period for bringing in changes. Already, if you perceive that I am making changes, that's not because of me, it's because of my team. So the team is oriented to unleash the power of vibrance, as I said. What do we mean by that? In every area of activity where we have present, we have to make our presence felt, and we have to make our vibrancy felt. Where all we are there, equity derivatives, currency derivatives, commodity derivatives, interest rate derivatives, SME, mutual fund, RFQ platforms, retail debt. I can go on naming. Time is short for us, right? All of us have only specific tenure. In that we have to pick and choose. For us, for this current year, what we have picked and chosen is equity derivatives first, followed by equity, and then is currency options, to be very specific. In equity derivatives, we had 0 volumes, you know that, and today we are trying to see some green shoots. Maybe we will be able to grow with the support of one and all. And in respect of equity, we are currently clocking around 7% market share. My request to the market participants, particularly the institutional participants, is start putting some more volume with me. The moment I become 10% market share in the market, automatically the volumes start building up. Here again, I will be able to play a wonderful complementary role in the growth of the market as a whole, not by cannibalizing any market share. So just the initial push of increasing the volumes up to 10% is what is required. After that, the cycle on its own starts in a big way. So that is the second most important effort we are doing. Currency futures, we already have around 35 to 40% market share. So our focus is on currency options, where we have not opened much of an account. We do have a product which is trading, but not to the extent which in my opinion it can trade. So me and my team are working towards rejuvenating it. Once we have stabilized equity derivatives, that will be a major area of focus. SME, as you have seen, would be a real great focus for us. And mutual funds, again, because of its socio-economic impact and the financial savings being converted into capital market savings impact into the market, we will be focusing on. For as of now, these are the priorities that we have put in front of us. Commodities, later next interest rate derivatives will all follow. Interest rate derivatives is a slightly complex product for India. There are a lot of changes that need to happen in Indian markets for that to happen. So that will take some time. Certainly this will be our approach and this will be our strategy. My team is fully tuned and aligned with what we are talking. In fact, what I am telling is not my strategy. This is what we as a team felt that we should do.
You also have a lot of investments in some of the other companies, CDSL, many others. How are they doing? You're hoping to keep them on for now, or some value unlocking?
So by and large, they all are doing well. And by and large, we have a very close oversight over what we have invested in and how we are doing. Many of them are very early days for the investments. Many investments start giving you fruits only when the initial minimum gestation period is over. So most of them are in those areas. Of course, CDSL and all are in advanced stages, and which is what we are seeing.
One last word, because you're also somebody who keeps a very close eye on risk, being a risk manager as well. How do you see the environment right now? Because beyond the market froth or not froth or valuation, only on the regulatory side, and how exchanges and regulator are working in tandem to ensure a very good, vibrant environment exists in the market. In many years back, decades back, the market was so concentrated. Few people could concentrate positions, this, that, all of those years of the past. How would you see the market right now on risk parameters?
I would see you touched upon the regulatory relationship with exchanges and how the regulatory formulation happens in this country. I must say it's a role model for the entire world. The way in which our country has progressed in regulation making, the consultative approach that it follows, the committee-based methodologies applied to evolve policy formulations in the larger interest of public, the consultative papers that come into the public domain, allowing everybody and anybody to have a say on what is being proposed to be called as a regulation. I think these are all very great measures, and I would say they are benchmark for the global economy to look into and emulate.
All right, there you have it. That's the view coming in from the BSE MD and CEO, talking about how they are now relaunching the Sensex derivatives in a new form. They're seeing good growth in the Star MF platform in the next few years. As he said, is going to be a golden era for India. All right, moving from one exclusive voice to another then, and ET now caught up with GMR Group's Saurabh Chawla. He laid out the growth map for the company. Growth roadmap for the company, sharing their expansion plans, talking about the updates on the Mopa airport. Let's hear him out.
Just to give that guidance, the traffic, even adjusted for seasonality, is doing better than what we had budgeted in our business plan. The interesting fact is that while the ATMs, the air traffic movements, they are still have not picked up because of shortage of aircrafts, but the capacity utilization in the aircraft has gone up substantially, and hence we see a pretty robust growth in traffic in line with our forecasts.
Okay, so that's good to hear that the traffic is actually better than what you had internally estimated itself. But talk to us about the latest addition to your portfolio, which is the Mopa at Goa. How's that ramping up? Is that completely operational now? Have the footfalls been really strong there as well?
Absolutely, it's shaping up very well. Interestingly, at Mopa, we have achieved ATMs higher than the other airport over there, and the traffic is shaping up quite well. We were doing about 10 to 11,000 passengers per day in Q4, and that momentum continues. Of course, there's a little bit of seasonality in Goa because of the rains and during the summer period, and also some impact because of GoAir. But very quickly, the GoAir capacity has got absorbed by the other airlines. So things are shaping up quite well at Mopa also.
Okay, that's great to hear. And I understand you do have some expansion plans underway, or at least planned for your Delhi as well as Hyderabad projects. Talk to us about that. What's the timeline of that? What kind of capex you have earmarked in terms of the expansion plans for Delhi as well as Hyderabad?
So Hyderabad is getting completed within the second quarter of this fiscal year. So end of second quarter, it's getting completed. It will take the capacity northward of 30 odd million passengers per annum. So that is now behind us. It's only minimal capex that was budgeted earlier, which is getting expended as we speak to complete the terminals as such. Delhi will take till the end of this calendar year or maybe early next year. And this is the redevelopment of Terminal 1, which used to be earlier totally dedicated towards the domestic traffic. That construction is underway. As you would be aware, Delhi traffic, we are creating this capacity to take it northward of 100 million at Delhi. And it's a critical capacity that will come up to the gateway of India and also help us to make Delhi as a hub for many of the airlines, especially Air India and Indigo, which have large operations out of Delhi. So it's already underway. Delhi capex is which started almost 3 years back. That had a total capex budgeted for almost 10,500 crores. So that is also now nearing its end. In next 6 months, we should complete that process also.
Okay, so that's great to hear. The expansion plans right on track. But since we're talking about expansion and capex, talk to me about the potential as well in the country, because the government has been quite vocal about their push of increasing the airport infrastructure, bringing in new airports to the tier 2, tier 3 cities as well. Which are the cities or the projects that you have under pipeline or on the anvil that you would like to bid for?
So right now we have 3 operational airports, Anisha, Delhi, Hyderabad, and Mopa, Goa. We are beginning the construction at Bhogapuram, which is the airport in Visakhapatnam. So these are 4 live projects. We have won the concession in Nagpur, but we are yet to sign the concession agreement over there. That's a brownfield airport, and we'll be expanding that also as and when the concession agreement is signed. So these will be in our portfolio, these are 5 airports which are there. Going forward, the government of India has announced privatizations of a number of airports, but I think that process is still not completed. But we would be actively looking at participating in those privatizations as and when they come to the market. From our side, our focus, honestly speaking, is to create a profitable operation because now the capex at both Hyderabad and Delhi are getting completed. We should see profitable operations in Hyderabad to begin with, and then over the next 2 to 3 years in Delhi. Our whole focus is profitability, generation of free cash, and return to shareholders. That is the focus, not merely addition of airports into our portfolio. To answer your earlier question, India offers tremendous opportunity in the aviation sector. We are today at the same place where China was about 15, 18 years back. When Chinese per capita income was about $2,500 per annum, India is exactly at the same place. And if you look at the growth of aviation in China, India is replicating similar or even better growth opportunities over there. It's extremely important that aviation sector spreads across a large country. Cost of travel, cost of logistics is very important. It needs to be brought down, and hence efficient airport operations across the country is one of the precursors to develop a very efficient markets. So we are at the start of this curve, and very exciting prospects as we go forward. And you must have seen how both Air India and Indigo have ordered the aircrafts. I think this optimism flows through the whole aviation sector.
Oh, well, yes, you hit the nail on the head. The optimism is quite palpable as far as the entire aviation sector is concerned. But sort of wanted to get a sense from you with respect to the tariff revisions and the shares that you have with the airport authority. Is there anything coming up for revision soon?
So Delhi, the revision will happen from 1st April next year. That process of revision will go through a regulatory framework. Other than that, there is no... yes, of course, in Goa also, the tariff has to be set by the regulator. And that should happen by end of September, early October this year itself. So these are 2 tariff settings that will happen over the next 12 odd months.
Yeah, but what's the expectation with respect to that tariff setting? What kind of growth that you are envisaging, let's say, when it comes to Delhi next year, or even with respect to MOPA, what are you proposing?
No, no. It's a complex mechanism of tariff setting. It depends upon what is the regulated asset base that is set up. So I would not hazard a guess over there. But obviously, we are expecting better tariffs to come from the regulator. We'll allow that process to play out, and I'm sure it will be done in a very rational manner, as it has been done in the past. A lot of the uncertainty in tariff setting mechanisms are behind us. So I think now it's a very mature mechanism, and we will go through that.
Sure, we'll wait for the process to play out as far as the tariff setting is concerned. But talk to me about how you're looking at tapping into the Delhi duty-free value unlocking.
So, I mean, it's part of the Delhi airport play. What we are doing is, and that is not only restricted to Delhi, but as a general play, what we have decided is in competition with other duty-free players across the world, our platform, which is GMR Airports Limited, which is a JV between us and Group ADP, which is the French government-owned airport entity. We intend to participate in the future bids that come for duty-free and other non-aero businesses. These bids will come up within our portfolio also, and also across the world. So that is our focus going forward as to how to increase our non-aero revenues, and duty-free forms a predominant part of it. So that's how we intend to go, scale up those businesses at the both in India and at the global levels, and then see how to unlock value in those businesses. Very early stage right now, but yes, that is the path that we intend to take forward.
Right. Okay, let's move on then, and let's talk about the spacecraft space, which is clearly locked and loaded. In just a few hours from now, Chandrayaan-3 will be taking off from the Satish Dhawan Space Center in Sriharikota. The spacecraft, in fact, is scheduled to take off at 2:35 this afternoon, provided all things go well. But which are the key players that are part of this crucial mission? Sharad is here to tell us more.
Well, yes, the mission Moon is there, and Chandrayaan-3's launch is expected today. Now, the soft landing on Moon would be there, and of course, this feat has been achieved by only 3 countries or 3 nations: US, China, and erstwhile Soviet Union. And rover will be actually going after exploring the lunar surface as well as the experiments. But now let's look at which are the important stocks which should be in focus, and of course the stocks which are there in the Indian Space Association members. Big names, L&T is there, MapMyIndia, Nelco, Bharti Airtel, and even from the small cap space we are having Walchand Industries. But there are certain stocks which have actually used components they have given for this mission, and L&T is one of the most important ones. They are having roughly a 5-decade experience and partnership with ISRO, and they had actually supplied subsystems as well as mission tracking. For MTAR Tech also, core parts have been given in the last mission. This is for the both segments, engines as well as pumps. In the small cap sales, we have Centum Electronics. They have roughly made 300 to 500 components for the Indian space missions. So that is a very important thing. Apart from this, even HAL and Sundaram Fasteners, these two are also stocks which have actually contributed massively when it comes to providing components on various previous launches for Chandrayaan missions.
Right, Sharad, we'll leave it at that. In fact, welcome on board Rohan Verma, the CEO and ED at MapMyIndia, on the show to talk about how India Inc. can actually participate in ISRO's space mission. Rohan, hi, morning. Great to have you in ET Now. Rohan, more so one is saying that there is larger participation from amidst private players onto such as, a mission such as Chandrayaan, for instance. When it comes to satellite launch services, tell me what could be the participation of the private sector in the times to come, and how is it that you at MapMyIndia play a role in this?
Hi, thanks for having me on your show. Actually, this democratization of satellite technology, and especially downstream applications, which are the largest value share of the value chain in the space industry, is happening has been happening organically, but also is getting a fillip because the government is kind of pushing satellite launch services, both in terms of reducing or removing the GST, but also encouraging more private participation, which means more satellites. Now, Earth observation satellites, positioning, navigation, and timing satellites, and communication satellites. From MapMiners perspective, because our Mapples app, as you can see, which is free for users, or our enterprise solutions, or our IoT devices, all are leveraging these types of satellite technologies to create applications which benefit users. So we see this as a fillip to our products, our business, and ultimately the value being given to consumers who use the Mapples app, or to enterprises, both in the government, defense, as well as in the private sector, who use our geospatial analytics, who use our satellite imagery analytics, who use our GPS and Navic-based IoT devices. So it's time for Indian companies, and those especially in the value chain of the space or geospatial sector.
All right. Thanks so much for taking time out, Rohan, and joining in. I wanted to also get in your take then as to what the industry is really feeling like and what the outlook is like for some of the private players such as yours in terms of the exposure to revenue from the defense segment as a whole.
Yeah, I mean, I think there's a lot of positivity. For the longest time, getting into the defense sector, even into the space sector, was a very, very hard thing. There were very few that could get in. We've been lucky in the last few years as MapMindia to be working with ISRO, who is our customer, but also working with ISRO, who's our partner, with whom we mutually exchange maps and satellite imagery. And of course, we sell IoT devices based on Navic. Even with the defense, geospatial and space is a strategic sector. The more indigenous maps and technologies are used by civilians or private sector, the more it gives strategic resilience and geopolitical power to Indian government. But also the defense becomes more capable. And so the work that we are doing with them is really to bring our cutting edge technology and maps, those 3D, 4D, high definition maps, geospatial analytics, navigation technology, to enable the armed forces to be better equipped to defend India. So it's an exciting time. We are well placed. And so is the rest of the industry. The best of the industry will be chosen to work with defense and space. So I think this creates kind of this path for high-end technology products and platforms company to really kind of scale in this area of defense and space.
Hi Rohan, this is Anish also joining in the conversation. So defense is one vertical that you're watching out for, but the mainstay continues to be the navigation vehicles and all of that, right? And you're expecting quite a bit of growth there as well. There are reports talking about how that could be 3x in the coming years. Could you talk to us about which new OEMs have you onboarded, how the overall demand sentiment is like when it comes to the growth in the navigation vehicle segment?
Yeah, actually, almost every OEM works with me and works with us, MapMindia. And four-wheelers, almost everybody. Two-wheelers, the exciting part was this Harley Davidson being launched by Hero. That, of course, comes with MapMindia built in. That's something that went live recently. But not just them. I think almost every new vehicle launch that you are seeing, for example, Suzuki did the MPV, that comes with MapMindia in the Suzuki Connect, for example. So you're seeing almost all OEMs use MapMindia in that way. And just to kind of highlight the kind of scale that we're seeing, the MapMindia free consumer navigation app is actually #1 on the charts right now, having Google Maps. Who would have ever thought that on Apple phones or or any free consumer app alternative to Google Maps could be the #1. But there's so many new features we provide from a safety point of view that more and more people are downloading the free Mapples app, and it's risen to the #1 in the charts. And we're seeing huge momentum there as well.
Is that the reason you're confident about achieving 1,000 crore revenue by FY28? Because that's almost a 30% CAGR.
Yeah, I mean, we did our investor analyst day, recently, and we basically gave the path that, look, our different industry verticals. So automotive, government, corporate, and mobility. All of them based on a large open order book, based on our position, and based on the market seeing the value in us. You've seen our track record of CAGR already at 35-40% in the last few years. So we see no reason why, in the next 4 to 5 years, we can't do 1,000+ crores. And we laid out like a detailed plan explaining that to the audience, as well as the use cases where people are using us. So yeah, we're quite confident, quite excited, and there's a lot more to come as well.
On that note, we'll let you go. Thank you so much for joining us. You're quite excited about your journey going forward, and I'm sure so is the case with the Senco management as well, because that stock is just listing on the bourses as we speak. You have the live visuals coming in from the exchanges, and it seems like it has had a good listing. That was the expectation. It's 38% higher as we speak, almost a 39% listing gain. So the stock stands at around 440 thereabouts. This is something we have been highlighting earlier as well with respect to the kind of demand and the subscription that Senco has got already 39% higher. Of course, as far as the valuation is concerned, from the likes of Titan and Kalyan, it's coming at much cheaper valuations because Kalyan was trading at around 34 times. Titan is well above 80 times. Even after this uptick, my guess is that Senco should be around 20 times the forward earnings, and that compares with almost 33x that we have seen from the other names as well, guys.
Yeah. Okay, that's Senco in trade for you. 38% premium is what it's listed at to its issue price. Let's see how during the day it actually scales up. But stay tuned. We've got a special interaction with famed venture capitalist Vinod Khosla. He's going to be sharing his views on startup funding and, of course, investments as well.
India is a very good place where alternatives to China can develop. And so I'm very bullish on that. Having said that, I don't think you do it the same way China did it. China did it with very low-cost labor from villages into cities, into manufacturing centers. I think what India should do is take manufacturing expertise. So use engineering talent to reduce the cost of manufacturing, because the world won't pay more just because it's outside of China or made in India. And so you have to get the same cost. You can get there by either having lower cost labor or having lower cost engineering talent that reduces the manufacturing, the labor content of manufacturing. And I think that's a better approach for companies in India to take. The good entrepreneurs will set up culture in the company where even a junior engineer can challenge the CEO with questions. And I think in that kind of a culture, you will discover problems early, you will fix them earlier, and you'll build better companies, faster companies. And I think that culture is somewhat missing in India because there's a more hierarchical nature to those startups instead of anybody being able to challenge anybody. So that's my one piece of advice to entrepreneurs.
Okay, we'll be getting you that conversation at around 10:20 a.m. But let's move right on and get a status check as to what the banking system looks like in India. We've got Pranav Gundlapalli, who is the senior research analyst at Stanford Bernstein, now joining in. Thanks so much for taking time out. I just wanted to understand what your outlook is on the Indian banking system as a whole, because if, for instance, if we even take the clock back to the SVB collapse, etc., we didn't really see that contagion impact or effect really play out back home. What's your assessment overall as to how the banking system has fared?
Morning, and thank you for having me on the show. I think Indian banking sector overall is in a very sweet spot. It's an outlier versus many other regional banking sectors. And a lot of it comes down to the last decade where it hardly saw any growth as percentage of GDP. So it was a muted growth last decade, which is now put it in a nice position with respect to growth and with respect to margins as well. The rates are at somewhere in midpoint of what you've seen the last decade. So it's a very nice, comfortable spot for the sector, and it should see a very healthy compounding story from here on for the next 5 to 7 years at least.
5 to 7 years look quite interesting for the entire financial space. But there was this worry, Pranav, that there could be a bit of a margin compression as well. Is that something that you think will play out incrementally going forward, or not too worried about that?
See, yes, there will be margin compression. Right? I think on a Q-on-Q basis, yes, I expect about 10 to 15 bips of margin compression for the sector. But remember that the last year saw an extremely large margin expansion. So some of that gains will go away. And it's driven by three factors really, right? So one, you have higher rates now, which means there will be a natural migration away from low-cost CASA deposits into term deposits, which increases the bank's cost of funds. And within the term deposits, last year saw a muted increase in the rates, despite the sharp increase in benchmark rates. So some of that gets priced in. So that again drives up the cost of funds. Lastly, the last quarter or so saw a stabilization of the rates environment. So you didn't have any benchmark rate hikes, which means that the upside on the loan pricing also becomes limited. So yes, there will be a Q-on-Q compression, but when you look at on a year-on-year basis, it's still a very healthy increase. And even within the sector, there's going to be some dispersion, right? So the banks with higher share of retail loans and weaker deposit franchise, by which I mean banks that have to reprice CASA or maybe and TDs more aggressively than others, will see a sharper compression compared to banks like say an SBI, which has a higher share of MCLR loans and a much stronger deposit franchise. They might see much lesser or maybe even a slight increase in margins on a Q-on-Q basis.
Sure, point taken, Pranav. But what's your view about the mega merger of the HDFC twins, and now that the merged entity is listed, what's your view with respect to how that's likely to pan out?
We have a positive view on the merger, and we think it'll be benign from a growth and profitability perspective. In other words, the bank's trajectory of getting that 17 to 19% growth and near 2% ROA should not be at risk. That is more on a near-term perspective. At a longer perspective, I think it's great for the bank because it gives them a scale advantage, which is almost permanent. When I talk about scale advantage, I'm referring to the simple OPEX to assets ratio, which will almost be 50 bips lower than that of their peers, private sector peers. And that could be a permanent advantage that the bank carries forward, right? I think as the deposit costs normalize, that scale advantage will begin to shine, and that will be a big positive for the bank.
Now, given that the outlook is that there's going to be a limited sequential improvement in profitability, is this isolated to certain types of banks, or is it going to be across the board, and what's the rationale?
So I think sequentially, yes, the profitability growth would be limited, but it is at a pretty healthy level at this stage. And therefore, the differentiation will come down to growth eventually. And there, in terms of EPS growth, and there, I think the constraint will soon become the deposit gathering ability. Right? I think this is a big shift away from the last decade story, where the underwriting differentiation is all that mattered. So banks won or lost depending on how good their asset quality was. But now it comes back to deposits. Now, this deposit competition and the intensity probably starts a few quarters later than what we expected. Because the first quarter, thanks to the note bans and other stuff, you had a much stronger deposit growth than what we anticipated. So the real intensity will probably pick up in the later half of the year. And that's when you will start seeing differentiation in growth, which then drives to differentiation in the earnings growth for these banks.
Pranav, before we let you go, give us a pecking order in terms of the large cap banks that you like, the mid cap banks and NBFCs. Which are your top ideas right now?
So amongst the large banks, for us, we think this is how we think about it, right? So we think the compounding story is largely going to be similar across banks, right? So you're talking about high teens compounding of the book value growth. Therefore, the rank order is largely our view on where we see a re-rating potential, the multiples being improved. And in that perspective, for us, the rank order is HDFC Bank at the top, where we see the merger, with the merger overhang gone in the next few quarters, we see a clear case for re-rating. Second would be in Axis Bank, where it is still significantly cheaper versus peers, and for a reason. And as the quality of the franchise improves and bridges the gap with peers, we expect that re-rating to happen for the bank as well. Third would be SBI amongst the larger banks for two reasons. One, once the corporate credit cycle comes back, which looks more likely to be happening in the next year or so, then SBI stands to benefit significantly versus other banks. So that's one reason. And the second is there is an overhang of capital raise, which again, if it goes away, can drive a significant re-rating for the bank. So these are the top three for us where we see a re-rating potential. ICICI, I think, will continue delivering earnings growth, in a very healthy manner, but limited options or limited potential for a multiple re-rating from here. Right? So that's why it becomes a fourth in our rank order. Now, at this stage, with rate hikes probably done, NBFCs could be a cyclical play, and so as some of the smaller banks, which share the same characteristics of NBFCs in terms of being more sensitive to rates on the cost of fund side. But we think that story is going to get harder and harder as the deposit repricing happens and the margins start compressing for some of these banks.
Okay, so you're staying away, you're saying, from NBFCs and mid-cap banks and stay with the large caps?
Yes, I would say the large caps for now.
Now, on that note, we'll let you go. Thank you so much for joining us and talking to us about the entire banking sector at play. Quick look at the markets before we move forward. The Nifty is at 17,441, so giving up a bit of its gains, but can't say the same about JBM Auto. That's higher by 11%. GE Shipping is up 6%. NCC is having a solid run today. Ditto is the case for Patanjali Foods as well. On the losing side, Mazgaon is seeing some profit booking. Finally, after the kind of week it has had, Mazgaon is finally seeing a cut of almost 4%, and similar story for Data Patterns as well as Max Healthcare. But on that note, stepping into a very short break, don't go anywhere.